What's up, everybody? It's Jadu and Jonah from the Cash Compound, and we're here to help you understand a money mathematics lesson as we explore your wealth, your money, by growing it without locking it up, giving up control, or taking on risks. So now we're going to do a little comparison game. We've been doing these for a couple of weeks here, and I think it's really helpful to a lot of people to break down traditional, investment or savings vehicles with what we do and with what we teach, the flexibility, the options, the pros, the cons of a banking system.
Yep. So this one this week is pretty popular with some of the older folks.
Okay.
These were super popular maybe about 5, 10, 15 years ago. And so I thought, hey, why don't we talk about it? Let's compare and contrast. Let's talk about what really is going on with normal people if they've got one of these and how it compares to a banking system.
And what is it, you ask, ladies and gentlemen? CD.
It's a certificate of deposit.
Okay, so I'm going to play the CD holder.
Okay.
I'm going to play the person who got one of these from a traditional banking establishment.
Cool.
And Jonah, who will you be?
Yeah, I'm going to play the banking policy. I think I get the good end of the stick, but we'll see. We'll compare. We'll talk it through. You guys let us know at home.
You be the judge.
Yeah, who's got the better deal when we go through it.
Okay, so we have to start from apples to apples.
Yep.
Have a comparison that is on a level playing field. It's very important to start that way so you can frame your mind around what's really going on here.
That's right.
So we're going to start with certificate of deposit. So if you don't know what that is a promise to leave your money in a banking institution for an amount of time for a guaranteed interest rate.
Yep.
So we're talking about interest, we're talking about compound interest, and we're going to compare those things. So I think you guys know what a CD is out there.
Sure.
Have you ever had one? You ever bought one?
I've actually not had a CD.
I have in
Okay.
the past. So I know all about it.
Okay, perfect.
And like you said, there's a lot of folks who are in probably a generation or two or three above us who are more familiar with these savings type vehicles. And we always heard about like your grandma buying you a CD or something for a couple years when you're first born, or that type of environment, I think.
Right. So in order to start at the beginning, I know a thing or two about CDs. So in order to start at the beginning, I think you have to pick a term for your CD.
You do. So now that there's many online options, which maybe didn't exist when I was born 30 plus years ago, but now you can basically pick your term. It can be anywhere from like 3 months or so to 5, 10 years, where you want to be able to guarantee and lock in the rate. So as your bank potentially does not offer this level of interest rate, 1, 2, 3, 4, 5, 6, 7%, you can get that in theory with a CD, and it'll lock it in. Okay, so here we go. Let's start out with the same amount of money. Okay,
sure.
Same amount of money. So which amount of dollars are we going to deposit? You get to pick.
Let's do $10,000.
$10,000.
Let's do $10,000.
Okay.
I'm putting $10,000 in a banking policy. You're putting $10,000 in a CD. Now you've had to pick a term, and I'm assuming you've picked a long enough term because you want a good interest rate. The interest rate depends on the term you pick, right?
Right. It'll go up and be higher the longer you want to lock up your money.
Right.
Which, of course, is one of the tenets we talk about all the time, in that you don't have to lock up your money long term.
Right, in the banking system.
But a CD does.
Right. So if you said you can do terms like a month or 3 months, 6 months, something like that. If you're picking one of those, I'm sure you're not getting any type of decent interest rate.
We got to put it in for a while. If you're going to do $10,000, it depends on who you are out there, and we're not going to prejudge that. But let's go for longer than a year, because for a true comparison, we need to get this thing in for probably at least 5 years to even be talking about similarities in what the performance would be.
No problem. Sounds good.
Okay, so if we're going to do that, ladies and gentlemen, $10,000 in what's significant, let's talk about this, then I've got already out of the bat a guaranteed growth rate.
Cool.
And if I'm doing 5 years at 10,000, probably in 2020, in the environment we're talking about, I am going to potentially approach what you are going to say your guaranteed growth rate is.
You read my mind. So I'm getting a guaranteed growth rate from the beginning on that $10,000 deposit into my banking system of 4%.
It's very likely
Okay.
I could reach that number with 5 years and $10,000.
Okay, no problem. Very likely. That's a good. Last time we did a comparison, I think you had a good track record. So this time you're just very likely. So I like
very
that.
likely. I would say
very
So
likely.
if I don't pick 10,000 and you're using a CD for less than 5 years, less than $10,000, I'm not seeing anything online these days. When I looked it up, near 4%.
No problem. What about principal protection?
Yes. So what's great about what I have is I've got the FDIC backing my numbers up to probably 250,000.
Cool.
So I am good to go. I will not lose money. I'm guaranteed to go up to potentially 4%. So let's say 4%.
I love it. Okay, that sounds good. Now, so here's a big question. And I'm just wondering if you know maybe like the ins and outs or just what happens if you can do it. So like a big thing is, like you mentioned, you've kind of got to lock some money in there for a good amount of time to kind of get the growth rate, the guaranteed. So that's cool. I mean, that's no problem.
It's a great place to put my savings for an emergency.
Okay.
Like a long-term savings plan for a car or a house purchase or the 50th anniversary that I know I don't need for 5 years.
Yep. So cool. So let's talk about it. Your 50th anniversary is coming up. That house purchase is coming up, and you want to make a move like before your term is over. Is there any way you can maybe stop it early and get some of the money out? Just like if you said emergency.
Yes,
so if an emergency happens,
not without losing my growth.
Okay. Not great. Not great. Okay.
And you remind everybody how that compares with you?
Yeah.
Could you do that?
Yeah. So I think I kind of asked 2 questions. So I'll answer them both. So first, just in case I just absolutely needed to get in there and get some of the money out, I'm going to have that flexibility really from the start of my policy. And there's not going to be any penalty or fee, kind of associated or tacked on. So a little different. Because I'm not worrying about that. So just in case an emergency really does happen and we're saving up for emergency, or the house we're saving up for, we want to purchase that house, but a perfect deal comes through and you got to move on it now. That offer's got to be in by the end of the day. I'm good to go.
Okay.
Yeah. So that's a pretty good thing.
Okay. Now that was both of your questions. You said you asked 2 questions.
Yeah. Okay, it was just if you could get it out.
Yep.
Right away. And what happens if you have to take it out? And,
cool.
Yeah.
So here's one thing that's really great about what I'm doing. Obviously, we talked about a 5-year potential term, but let's remind everybody one of the benefits that I have, and I just want to hear you and see if I can catch you off guard.
Okay.
If I had a 1-year term on mine, that means, let's say it was 4%, there may be a CD out there, who knows? A 4% 1-year term. So if I had 10,000, I'd have $10,400 to take in month 12.
At the end of the year.
At the end of the year, how much money would you have?
Okay. Well, I think you got me there, because when the way that our banking system is set up is that the money that we put in, the 10,000 that we both put in, that is earning guaranteed 4% interest. It's in the contract there. So we were kind of matched on that. But at the end of the year, what we are going to take out of the policy is actually not going to be a withdrawal from what we put in. We're actually going to use that $10,000. The insurance company is going to collateralize it for us, and we're going to take out an insurance company loan, and it's going to be about maybe 55%, so somewhere around $5,000. So,
so I got 10,400.
Yeah, okay.
You only got 5,000.
Yeah, that's absolutely. But you had to wait all year to get it. You couldn't take it out without penalties and fees, right? And if you take it out again, if you want your 10,400. You need to take it out, right? Which means you're not growing anymore because you took it out.
I guess so. Right.
Right. Well, that's not happening over here. So sure, our usable cash at the end of 1 year might be a little different, but I'm still earning interest on that 10, even though I can still use maybe that 55%.
Well, I can put my 10,400 now back in for a new term, and now I'm compound interest. Sure. So I had 10,000. I now have 10,400. So compound interest is interest on interest. I'll also be earning interest on the $400 that I did not have to come out of pocket for.
Okay, but 2 things for that one. I thought the plan was to save it up so you could use it.
I'm trying to show off all the great things that I can do.
No problem. That's
you
cool.
said what if. I'm doing what if as well.
Okay, no problem. So at the end of the year, you're going to take what you earned and you're going to put it back into the term again for the CD. Right?
That is correct. So
okay, so if you're going to do it, I can do it.
Okay.
Right. So at the end of the 1 year, so at the end of the 1 year, so again, I've still got the 10,000 earning interest the whole time, even though I spent, 5,000, 5,500, 55% in that first year.
Money. Okay.
Yeah, I can. So I bought some stuff that you didn't buy, which is fine.
I didn't need it.
I mean, I thought the whole point of having money is so you can buy stuff, spend stuff, give it away.
I'm a saver.
Okay. Well, okay. You got saving for something. Okay. But at the end of the second year, I'm going to also
saving for commas.
Okay. At the end of the second year, I can also, if you're going to put the money back in, so can I. You put 10,400 back in. So if I put 10,000 back in to my policy, I'm now earning on $20,000. I got 10 from the first year, 10 from the second year. In your scenario, you had 10, you made 10,400, you put 10 back in. It's still just 10 that you're earning off. 10,400. I'm earning off 20. You're at 10,400. If that's what you want to do,
I guess
since we're saving. For commas.
So. Right. 5 years. Okay. So let's talk about another piece of the comparison puzzle.
Okay.
What is another argument? So what do you want to ask me about my great plan, my tried and true traditional plan that grandmas and grandmas have been doing?
Yeah. So what about taxes?
Taxes.
You made 10,400, so are you going to have taxes on that growth?
Well, I'm not if I leave it in. Tax will be deferred until I actually catch up.
Hey, no problem.
I haven't had to pay any taxes as long as I put it back in there.
So we're going to leave it in for 5 years. So I'll give you that for 5 years. But at 5 years, you're coming out. You're taking it out because it's time to buy something. It's time to pay for the birthday party, the 50th, the retirement. It's time to buy the house. It's time to buy the new car. So at the end of 5 years, what about then?
My growth does qualify as income. Okay. There will be taxes.
Okay, so there are taxes. That's what I need to know. No taxes going on over here. You don't have to pay. Remember I said our 10,000 is collateralized. We're going to take a loan from the insurance company. Loans are not considered income in the eyes of the IRS.
Gotcha.
So there's going to be no taxes over here. So, okay. So that was a thing I was interested in knowing. What about, let's see. What about if something happens to you during the CD term? So you said you're going to pick the term for 5 years, but what happens if you pass in the fourth year? 5 years are going to go by. You're going to have a good amount of money. You're going to earn guaranteed interest for 5 years, right? You're going to have a good amount of money at the end of 5 years. What happens if something happens to you in the fourth year?
Then,
does your spouse can your spouse take it out in the fifth year?
Yes, I can. Obviously, my spouse. I'm buying these products from traditional banking, conventional banking institutions. Okay. So, sure, joint account. My spouse can get to it, no problem.
Okay. So what happens if you didn't do a joint account? You forgot, maybe you just set it up online, you did it real fast, and you forgot to put her name on it. They made you sign an extra piece of paper to get your spouse on it. You didn't do it. You were like, I can just do it by myself really quick online. I'll put the money in there. So does anything go to your family? Does anything go to your heirs? Does anything go to your spouse or children? Is there any type of...
The growth would go to them as long as they could figure out how to go get it. So obviously, I need to make sure I don't make that mistake about who's got access to this account at the bank or this particular CD. So I won't mess that up.
Okay, no problem. I'll give you that, which is, I think that's super important. If you're going to go ahead and earn money in a CD, you're probably savvy enough as well to make sure the other folks in your family know they can go get it.
That it's there.
Right, exactly. Mm-hmm. So maybe you didn't know. I think maybe you at home know that I'm going to have a death benefit attached to my banking policy. So while we're earning interest, while we're spending money, while we've got guaranteed growth, principal protection, no taxes, just in case something happens to me, there's going to be a much bigger payout to my family, my spouse, my kids, just in case something happens.
But what about your 20,000 that you've put in so far by year 2, or 30,000 or 40 or 50,000 in these first 5 years? Where does all that go? I'm not concerned about that. I don't think you should be concerned about that at home either. The death benefit that's attached to my policy is going to be way bigger than that. So my death benefit on a $10,000 policy in a person my age, my health, might be $200,000, $300,000, $400,000. So if I put in 20,000 or 50 after 5 years, right? 10,000 a year. If I put in 50,000, they're going to give me $500,000. I'm ahead.
I'm not worried about that 50,000.
Well, you're dead, but your family's ahead.
Well, my family's ahead. They're going to be happy
We're both dead, so it doesn't matter.
They're going to be happy I took care of them.
Right. Either way, we have to die sooner or later.
Right.
Doesn't matter what type
That's
of
right.
programs you own or investments you have or money you have. You can't use it if you're dead.
I want to ask a hard-hitting question.
Okay.
So this happens all the time where I am. Happens all the time. And when people with banking policies, they go, I love what's happening. A year in, 6 months in, a year and a half in, 2 years in. I love what's happening. Can I contribute more? So I'm asking you, can we put in more? You're like, this 4% I'm getting, this 5-year term, this is awesome. Can you put in more money? I've got more now. I want to put in more. I want to get the growth. Can you just up your CD limit?
Yes, I can. It's going to give it new terms.
Okay.
So I can add another CD. I can, when I roll it over year to year, potentially, I can add in, and it's a new term.
Okay. So basically you're like you start fresh from that
Yes,
date. Okay.
but I have more money, so my rate might be higher.
Okay.
Yeah.
That's good.
Yeah.
I mean, unless you need to take it out. Because, again, if you're going for 5 years because you're saving up for that house or that retirement party, and then you have more money in the middle and you have to redo the 5 years, you might miss your target.
Yes, I got to redo several pieces of the terms potentially. But, yes, there are plenty of CDs out there that let me put more money in. Once again, I got to lock it up for a while. Yeah. What a certificate of deposit is all about is I put money in and it's got to sit there for a while. And if I take it, then they don't have to honor whatever interest rate.
Yeah, man. Okay. Well, I've actually heard this about a few CDs as well, so I want your take. I promise you this is someone literally told me earlier today, talking about a CD today, that they keep missing their window when the CD ends.
When it matures.
So the CD's automatically rolling over again, and then they're keeping the money in the CD because they don't want to get the penalty by taking it out. So they actually wanted to stop their CD, but they can't catch it in the frame to stop it. Right. So that seems kind of crazy.
But power to them. One day they'll catch it, hopefully, and they'll have a couple dollars in there.
Okay.
But yeah, if you want to use the money, don't miss the window.
Okay.
Or else you're going to have a penalty and a fee for taking it out.
That's tough. Okay. What about inflation? Does your money get bigger like each year? Like, can you change your terms because of inflation?
No, it's actually, so it doesn't have any specific. Obviously, if I'm earning beyond the inflation rate, which is very hard these days, depending on how much money you're willing to lock up. Right. No, there's no particular inflation protection, but there is a guaranteed growth rate. So if I feel comfortable about that rate, then I'm not really thinking about inflation in 1 or 2 years, probably.
What about if you are determined sick, chronically ill, terminal illness? Any benefit? They give you a little bit more to help out with the bills?
No,
like that?
No, my money's locked up and they don't care about any of that stuff. Okay. Not that I've ever heard of.
Okay. Well, we got that too over here, just in case. I hope it doesn't happen, knock on wood, right? But just in case, we have that over here. What about creditors? Can creditors get in there?
Yeah, actually. So if creditors are after me, or if something goes south in my marriage or business deals, this would be kind of a potential liability in that situation. Yeah, so it's not quite as protected of an asset as I would want if something went wrong. Okay.
Well, I don't know about you, but in my opinion, CDs really sound like kind of the definition of locking that money. Like, I mean, you might certificate of deposit, you might as well call it certificate of locked away. I mean, it really seemed like you got to put it in there. You can't really use it. If you use it, it's going to reset the term. But the whole point was to have a term that you could get it out so you could use it for something. So, also, but at the same time, if you can't get to it, but the creditors can, that doesn't seem like a great, that doesn't give a great spot, man, you got to have taxes on the growth, not really fighting against inflation at all, man. Okay. That's where you wanted to put it?
I'm just saying it was a good option for grandmas out there. So,
man,
Ladies and gentlemen, you've seen a few of the pros and the cons to comparing what you can do inside of a private banking system and what we build at the Cash Compound every day. We just wanted to have a regular conversation meant for regular people's ears, just like yourself, on what many people do with their money each and every day that may or may not be actual helpful to you as you build your wealth and grow to be able to use the dollars that you've got for yourself. So if you want to know more information about what we do, hit us up, jump in the DMs, let us know that you want to have access to our free crash course where we help you understand what's going on in the world of money all around you that you have access to, but nobody ever taught you how to use. So we'll catch you next time as we crack the code to cash flow on another episode of our Money Mathematics.